My name's Ethan Braid. Today we're going to talk about how much tax you pay on $50,000 of dividend income. I'm going to show you the difference in taxation between ordinary dividends and qualified dividends. I'm also going to show you how much tax you would pay on rental income, annuity income, and interest, because all three of those items are categorized in the same way. You pay the same tax as you would ordinary dividend income. We're going to look at 4 different examples so you can see how stage of life and character of income affects the taxes that you pay on your dividend or investment income. First, we're going to look at a retiree who only has Social Security and dividend income. Then we're going to look at a retiree who has Social Security dividend income, but also IRA distribution income. Next, we'll look at a couple with a very high income to see how dividend or investment income is affected if you have a very high income. And finally, we'll look at a younger couple in their 40s who is building wealth and see how a moderate level of income impacts the taxes that you pay on dividends or investment income. Our first example will be for a retired couple that has $60,000 of Social Security and $50,000 of dividend or investment income. They are not yet taking any IRA distributions. What I'd like to draw your attention to right away is that under this qualified dividends category, you can see that 100% of the dividends are taxed at the 0% level. So this couple is only going to pay $433 of total tax for the year and 0 tax on the $50,000 of investment income because it's qualified dividend income. Now let's compare that to ordinary dividends. And by the way, ordinary dividends are taxed the same as annuity income, rental income, or interest. So if you have $50,000 of ordinary dividend or rental income, you ultimately end up paying $5,622 of tax on that income stream, all things held equal. So it makes a huge difference, the character of your income when you're in retirement, when it comes to how much tax you're going to pay on that income stream. Again, in this example, if you have annuity income or ordinary dividends, you're going to pay $5,622 more in tax than you would if your dividends were qualified dividends. If you're retired and paying an extra $5,622 in taxes every year on your retirement income just because it's from an annuity or CD interest or something like that versus qualified dividends, that really takes a bite out of how much money that you can spend. And think about spending that much money on taxes for a 25-year retirement. That's over $140,000 if you add it all up. So the next time someone tries to sell you a variable annuity and tells you how great it is for retirement income, run. It's not. It's a bad deal. Now let's take a look at a retiree who also has IRA distributions coming to them in addition to dividends. Our second illustration is for the same retired couple with $60,000 of Social Security, $50,000 of dividend or investment income, but additionally, they're receiving a $50,000 IRA distribution. Notice what happens to both qualified dividends and ordinary dividends. Because this couple has more income from the IRA distribution, a portion of their qualified dividends will now be taxed at the 15% level, and they're going to ultimately pay $3,698 of tax on their $50,000 of qualified dividends. However, if they're receiving ordinary dividends, i.e. rent, annuity income, interest, etc., that $50,000 is going to be subject to taxation of $8,437. So there's still a tax penalty for receiving ordinary dividend income versus qualified dividends. Most retirees will ultimately be in this illustration example, where they have some combination of IRA distribution / 401k distribution, dividend income, annuity income, rent, interest, etc., and then Social Security. I'd also like to point out that as your income level goes up, more of your Social Security becomes taxable. If we compare this example to the prior example, here we see that this couple will have $51,000 of their Social Security be subject to taxation, and that's because of the other income. But if we look at the prior example, only $36,600 is subject to taxation. So you can see what happens when you add in more money from the IRA distribution right here. The Social Security becomes taxed at a higher level. Now let's take a look at a high income couple to see how a very high level of income affects the taxation of your dividends or investment income. In this example, we have a couple in their 50s earning $600,000 a year and the same dividend or investment income stream of $50,000. Notice what happens when you start making a lot of money. The tax brackets move up. In this case, the entire $50,000 of ordinary dividends is going to be taxed at the 35% level, while the qualified dividends will be taxed partially at the 15% and the rest at the 20% level. In addition, we start to see taxes for Medicare showing up to cover the different healthcare plans, which will be the same amount of tax under both situations for ordinary dividends or qualified dividends. Ultimately, there will be tax of $11,253 on $50,000 of qualified dividends, or $19,400 on dividends that are ordinary or rent or interest, etc. This is a huge difference in taxation, $8,147 extra if you're receiving ordinary dividends versus qualified dividends. Our final example will be for a couple in their 40s earning $200,000 a year with $50,000 of dividend or investment income. Ultimately, the qualified dividend category is going to end up costing them $7,500, and if they're receiving ordinary dividends, rents, interest, etc., they would pay $11,395 in tax, for a net difference of $3,895 more if they're receiving rental income, interest, or ordinary dividends versus qualified dividends. So now you can see that the character of your income, qualified dividends versus ordinary dividends, rental income, annuity income, etc., is going to have a very significant impact on how much money you keep, the net amount that goes in your pocket, and the taxes that you ultimately pay. In these examples, you can see that there's a very significant difference in tax, and over 25, 30, or 40 years, that difference can really add up. It's a lot less money for you and a lot less money for your beneficiaries if you're constantly paying ordinary income tax rate versus qualified dividend tax rate. This is what I would call real tax planning. Taking a look at your income, the amount of money you have in qualified plans, any pensions, et cetera, and adding it all up, and then saying, well, how should we invest or think about investing? What amount of our income should be from qualified versus ordinary dividends? How's that going to impact us? That's real tax planning. A lot different from this nonsense that we all hear from just about every brokerage firm and financial advisor that's talking about tax efficient portfolios. What is that? And also, consider annuities. I just want to come back to that. Variable annuities are a bad deal, and now you can see why. When you're taking income from a variable annuity, any gains that you have in that contract will be subject to ordinary income tax rates. You never get away, right? And worse, when you pass away, a variable annuity, any deferred income in that contract will ultimately be taxed as ordinary income for your beneficiaries. Versus if you have investments, stocks, bonds, ETFs, whatever, in an after-tax brokerage account, when you pass away, those assets will qualify for stepped-up basis, and unless your estate is over about $26 million, your beneficiaries will inherit those tax-free. It's a very big deal. Real tax planning versus fluff. Anyways, I hope you've enjoyed this video. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.